what are contract specifications? And we hear this term, and I think, one of the great pieces of options in equity options is the uniformity. I don't care what you're trading. If you're trading an option on it, it's 100 shares. Now, they've got weeklies, they got monthly, they've got leaps. We're a different kind of leap. We're doing a good leap from, it's neither good nor bad. It's just long dated options. We're leaping
cooler leap.
Future, a cooler leap. I like that. Yeah. I got actually a wingman who can jump more than a foot. So that's kind of cool for me. So, what are contract specifications? We're going to talk a little bit about that. And John, let's bump one ahead if we could. So walk us through this, Jermal, and we could talk about uniformity versus a plethora of different sized.
How about these visual aids here? This is fantastic. So contract specifications are the size, tick, and expiration specific to a particular futures contract. Now, I know you're going to expound on this more, but I'm supposing that we have here, a lot of homogeneous symbols here with the stocks and ETFs versus futures. We got a bunch of different, type of figures we got going on here. So explain that to me, Pete. What we got?
And you're spot on. You're perfect in terms of what that elegant world of stocks and ETFs, 100 share blocks. Now you can trade lots of stocks. You can trade fractions of a share of stocks. We know that. That's another empowerment, is bringing another set of participants into the market. But in the world of options, what they did well from day one is, like you mentioned, they made everything 100 shares. So no matter you're trading Google, you're trading Amazon, you're trading ExxonMobil, that option is based off of 100 shares of the underlying. In the world of existing institutional futures, it's funny because I've created, and I didn't create these, thank God, the three of us, Franklin and Caberna, crafted this. And it's a great visual talking about disuniformity. And within the existing world of institutional futures, 1,000 barrels of crude, 100 ounces of gold. Within the equity index world, you would think, well, they rolled these up roughly at the same time. And when I say that, the same decade. One's got a 50 multiplier, one's got a 20 multiplier, one's got a 5 multiplier. What does that mean? Different tick sizes. So different contract sizes lead to different tick sizes. And then you've got this whole thing about, are they monthly expirations? Are they quarterlies? Or are they something like AGs, where you've got a planting cycle to be involved in? So you've got a May, a July, an August, and then a November. And it's like, why in the world? Well, if you were a farmer, you'd know, but we're not farmers. We don't want to be. I don't want to know that. I just want to know there's a two-sided market. Most importantly, there's good volatility, and there's a two-sided market in the options that underlying is based on. So these are the constraints that we fight with every day in the world of institutional futures. And size, I think size is important. Obviously, tick is in terms of owners, but size speaks to not only the contract multiplier, but understanding the notional that we're holding. So it crude at $63 times 1,000 barrels, 63,000. Now S&P's 50 times that index, and it's hard to believe that a mini S&P is worth $210,000 right now, which is just unbelievable. When I first started, I traded what they called the big before they built micros, and that was big at $80,000. Now we've gone from from 1/5 to 1/10 of that. So disuniformity in size creates confusion, and also that bad experience for us, because sometimes we're trading too big a product and we don't even understand it. So let's move on to the next spot.
What's interesting about this, and it's fine, we move forward, but the interesting thing about that is, you're right. There is a uniformity with stocks and ETFs, but I will say this: 100 shares of Amazon is not the same as 100 shares of like NEO, which is not the same as 100 shares of GM, right? And so I always thought it was interesting. Speaking of that prop firm background, one of the things that we used to do was look at this idea of dollar deltas. When you have a delta, but you multiply it by the price, right? And then then you can see the difference, because a 5% move in Amazon is totally different than a 5% move in GM. So I just thought that was, it is interesting. There's that uniformity, but not really. And I think, maybe there is that, there's a lot of things that are done right with options, and there seems to be a lot of things that are done right with futures as well.
Yeah. And it's a great point that understanding, I think.
He said 1 minute. Well, as we're heading into this, I might as well just.
I have had a technically challenged day. Yeah, at this point, I should just sit back and just listen to you, because I'm not doing. not doing I'm not carrying half the water here. So
we move past it, just like we said mistakes. We move on.
You're right. We're learning from that. And your takeaway is, hey, I don't want to work with him again. No. So that's a great point, is understanding notional, understanding its propensity to move. Mm-hmm. And it's a great point, because I think sometimes in my zeal, I oversimplify that concept. And it's great that we're talking about that, because the 100 shares is a great point to that. The difference in the notional or the underlying price of that stock is an important consideration. But when we look through that, the specifications, which is what we're talking about right now, is you've brought up such an important point in understanding sizing your trade. It's difficult to even get to that math. And I love you ran through that example perfectly. And it was a dollars to dollars example talking about stock underlying size. Here we're looking at, in the stock world, it's always 1 times the price. So each share is that amount. The tick is always a penny. Expiration, owning stock, this is one of the most interesting. I mean, you buy it, you kind of set it and forget it. And what I mean by that, you're buying it and you're paying for that stock either on Reg T, where you're borrowing some of the money, or you're paying for it outright, but there's no management. There's nothing you need to do with it short of tuck it away. Obviously there's a P&L effect, but nothing else you need to do with it.
So when we talk about, you said tick is always a penny. Is that for everything we're talking about, or tick sizes varies, right? Okay.
Right. And here we're talking about stocks and ETFs. And this is one of the things they did, which was great, is they made that uniformity between size, tick, and the ownership of not the options, but the underlyings is no expiration value. So that piece is great. And it helps you build those strategies and starts to give you a sense of size. So John, let's jump on to the next spot here.
Used to be probably smaller than, or not smaller, but fractional, probably many years back, right?
Right.
Or something like that, by quarters. Or...
Right. It's so interesting, because I remember, I think the minimum tick was quarters, and I remember this long time when it went down to an ace. The oh my God, they're making it too thin, and then we went to decimalized, and it was like, this is probably before you were born, but they started decimalization will destroy the marketplace, and what we've seen is the tighter we can get the bid offer, the more people, the lower we lower friction, the better it is for everyone. So this is just walking through one asset class, and walk us through a little bit of the difference here.
Okay. So here we have futures have specifications that were chosen for a specific institution at a specific point in time. So we have 3 futures symbols here, as far as I know. I think this is the YM is the Dow futures, right? NQ is NASDAQ. RTY is the Russell 2000. Mm-hmm. And so it appears that we have the size for Dow is 5 times the price. Right. NASDAQ is 20 times the price. And Russell is 50 times the price. And we have 3 different tick sizes here too. We have $1 for the Dow, quarter for the NASDAQ, and then a dime for the Russell. And expiration for all of these is at 8:30 a.m. Central Time on that 3rd Friday of the month.
Right. And now it's interesting. These were probably, these products were built ags were built in the teens. And since then, other physical commodities came. Then after the dollar came off of the gold standard, we got currencies and interest rates. Probably the last set of major products to be built are these equity indexes. So you see some of the similarity and some of the uniformity coming into this. Start of the equation is that expiration, but multipliers and tick sizes dramatically different. And I think when you start to figure that out, looking at a price, we want to make a decision on that price's movement in the binary outcome world of futures. It's very hard to do. And I'm curious, because I didn't know this answer, and I've heard different answers from different people. But when they were building these products, they built them at different times. They started with actually S&Ps, and then they moved on to NASDAQ. They added Dow, and Russell was probably the last equity index. Why do you think they went with the different size multipliers?
I have no idea, honestly. To confuse the hell out of everybody, I don't know. I don't know.
Well, you know what? I didn't know either. And it was interesting because it makes no sense now. And what they were trying to do, which is an interesting exercise, but doesn't make any sense, is they were trying to make the contracts the same notional size to start with. So they add another one. They tried to let's make it look notionally like the other one, the other two, the other three. So it becomes more of a tradable. It lives in that same size world. Well, when you think about it, though, it's trying to throw 4 balls to a guy at one time. I mean, they're never going to line up, and you're never going to be able to catch them. Just like you're never going to keep that specific set in time, the relative equivalence. I mean, for years, NASDAQ traded well below a notional value of S&Ps, traded well above it when we were at one point in cycle, and again below it. Same thing with all these. So it doesn't bring an answer that makes our life easier, but it does. That is one answer I've been told. I've also been told some others, and I think it speaks to there is no good answer. And I think going back in time, you probably would have seen a different methodology. But what we want to do is simplify part of this. So, in your mind, what would be the easiest way to simplify these pieces?
To remember them?
Yeah.
You're saying? Well, I guess one off the top of my head, you look at this and you realize, just based on the sheer sizes, and I honestly don't remember where everything is right now. I don't know. I'm guessing NASDAQ is around 13,000, Dow's around somewhere 30 something plus thousand, and Russell, this is just guessing right now, and Russell is somewhere around 2,200. I don't know, but the idea being,
spot on.
There's a higher multiple on the lower dollar index, if you will, and a lower tick on the lower dollar index in some way.
You're absolutely right, and the exercise you just walked through is the challenge. When I started from a single product guy, when I started trading D-marks before there even was a euro currency, I don't make it seem like in olden days, but you learn one set of contract specs. Now the good news, they don't change. The challenging news is we want product opportunity to change for us. We don't want to be the guy sitting and watching something else trade and not being able to get at it. Electronification has been the great equalizer in terms of access and in terms of liquidity. We want to take advantage of that. So, John, let's jump one ahead.
And people always remember all those ACT and SAT things practice back in the day. They come, they help out at some point. That's what we just did. That's what we just did.
Yeah, you're absolutely right. We tried to throw a dart at a moving target, but you know what? We're making the leap, and I think this is a great piece to kind of end this conversation on. Let's bring some uniformity in. So how do we do that, Jermal?
So rounding it out here, we have small specifications were crafted with the everyday trader in mind. Universal and standard across stocks, rates, foreign exchange, commodities, and more. So it looks like all the smalls, we have 100 times the price. So the size is uniform. Again, the tick, we have a penny. So that's uniform across all smalls. And as we talked about last week with expiration, and we're talking about again, all these expire at 3 p.m. Central Time on the third Friday of the month. So that's just across the board, super easy. I don't have to think about 100 or 500 or et cetera, all these different ticks. We have something that's standardized across the board. So that's real nice.